The mainstream financial media wants you to panic. They are aggressively pointing to the recent drop in the paper price of silver and telling you that the precious metals rally is officially over. They want you to believe that the smart money is selling. But behind closed doors, completely shielded from the public eye, sovereign nations and massive industrial conglomerates are quietly buying every single physical ounce they can get their hands on. Hello everyone, I am John A.G., and welcome back to the Wealth Reactor. Today, we are cutting through the daily market noise with a massive, urgent macroeconomic deep dive. If you are currently holding physical silver, or if you have been sitting on the sidelines waiting for the perfect entry point, you need to deeply understand the massive, historic disconnect that is unfolding right now between the digital paper derivative markets in the West and the physical, tangible reality in the East. This is the great wealth transfer of our lifetime, and you are living through it right now. Let us break down the exact data. We must begin by exposing the paper illusion. Over the last few trading sessions, we have seen the spot price of silver take a sudden hit, sliding down toward the $72 to $73 per ounce range. If you watch the mainstream financial networks, the anchors are using this price drop to mock retail stackers. But why is this paper price actually dropping? It is not because the world suddenly needs less silver. It is a classic, engineered cocktail of macroeconomic fear and algorithmic manipulation. Right now, global supply chains are under immense pressure. With geopolitical tensions stalling in the Middle East and the critical closure of the Strait of Hormuz, global crude oil prices have completely spiked. Wall Street institutions are absolutely terrified that this massive energy shock is going to cause consumer inflation to surge all over again. If inflation rebounds, that means the Federal Reserve and Chairman Kevin Warsh will be forced to keep interest rates significantly higher for much longer than the market originally anticipated. This is where the algorithmic warfare takes over. You have to understand that the daily paper price of silver is no longer decided by human beings sitting in a trading pit. It is controlled by massive, high-frequency trading algorithms housed in supercomputers. When interest rates stay high, the United States dollar gets stronger, and Treasury yields rise. These computer algorithms are explicitly programmed to blindly dump non-yielding paper assets, like silver futures contracts, the second they detect rising Treasury yields. The computers do not know what a solar panel is. They do not know what a physical vault is. They only read the interest rate data, and they execute billions of dollars in paper sell orders in a fraction of a second. That is exactly what caused the recent price drop. It is a digital illusion created by computers reacting to inflation fears. But while the Western algorithms are busy dumping unlimited paper contracts, what is the actual smart money doing? They are aggressively, relentlessly draining the physical vaults. This brings us to the undeniable, hard macroeconomic data. Just days ago, the highly respected Silver Institute released their annual global survey, confirming a terrifying mathematical reality for the heavily shorted bullion banks. The global silver market has officially entered its sixth consecutive year of a massive structural supply deficit. Let me repeat that, because it is the most important data point of the decade. We are in the sixth year of consuming more physical silver than we are producing. For the year 2026, the massive global shortfall is projected at tens of millions of ounces. To understand why this is happening, we have to look at the global mining sector, which is fundamentally broken and completely starved of capital. You cannot simply flip a switch and mine more silver. In fact, primary silver mines only account for roughly 27% of the global supply. The vast majority of the silver we get comes as a byproduct of mining for copper, zinc, and lead. But those massive base metal mines have been suffering from a severe lack of investment for the last decade. Furthermore, the actual quality of the ore being pulled out of the ground is steadily degrading. Miners are moving more dirt than ever before, burning incredibly expensive diesel fuel, just to extract fewer and fewer ounces of pure silver. Combine this with strict environmental regulations and massive geopolitical instability in major mining jurisdictions like Latin America, and you have a perfect storm. Global mining production is completely stagnating, and in many regions, it is actively declining. We simply cannot pull enough metal out of the ground to satisfy the explosive, price-inelastic demand coming from the modern industrial world. We are talking about the massive artificial intelligence data centers that require miles of highly conductive silver components to prevent overheating. We are talking about the advanced military infrastructure, the guidance systems of cruise missiles, and the massive electric vehicle gigafactories. But the biggest consumer of all is the solar industry. This brings us to the most shocking piece of data that just came out of the East, and why the West is about to lose control of the silver market forever. While Western retail investors are getting shaken out by a minor, algorithmically driven drop in the paper price, the nation of China just reported an absolute historic import shock. In the month of March alone, China imported a staggering 836 tons of physical silver. This marks a massive 78% increase from the previous month, and it hits the highest monthly import value ever recorded in history. Why is China buying 836 tons of physical silver in a single month? They are actively hoarding physical inventory to dominate the global energy grid. China controls the vast majority of the global solar panel manufacturing market. They are rapidly transitioning from older solar technologies to new, highly advanced N-type solar cells. These new, highly efficient solar panels require significantly more silver paste per unit than the older models. The Chinese industrial conglomerates know that there is a massive global supply deficit. They know that the global mining sector cannot keep up. So, they are securing their national supply right now, at any cost, before the Western vaults run completely dry. But it is not just the industrial sector in the East that is draining the physical market. It is also the everyday citizens. In the West, when the paper price of silver drops, retail investors panic and sell their physical coins back to the dealers. But in the East, the culture is entirely different. Chinese citizens are currently witnessing massive fragility in their own real estate sector and their traditional banking system. To protect their generational wealth, they are fleeing the fragile digital banking matrix by stacking small, physical silver bars and coins. They view physical silver as a deeply undervalued alternative to gold. This combination of desperate industrial hoarding and massive retail panic buying in the East has created a physical demand shock that the Western paper markets can no longer suppress. This is the exact reason why we are seeing a massive premium disconnect on the Shanghai Gold Exchange compared to the Western Commodity Exchange. The price of physical silver in China is trading significantly higher than the artificial paper price in London and New York. This massive price difference creates an arbitrage opportunity, which acts like a giant vacuum, sucking the physical metal out of the Western vaults and shipping it directly to the East, where it will likely never return to the open market. So, what is the final verdict for the Wealth Reactor community? How do we navigate this massive macroeconomic manipulation? You must completely separate the digital illusion from the physical reality. The paper spot price you see on your computer screen is currently being temporarily suppressed by algorithmic fear over Federal Reserve interest rates. It is a designed distraction. The bullion banks want to shake the weak hands out of the market. They want you to get frustrated, give up, and sell your physical assets back to them for cheap. But the actual physical metal is becoming fundamentally rarer by the day, and the Eastern economic powers are securing the global supply while it is still artificially cheap. Do not let algorithmic volatility scare you out of your hard assets. A temporary dip in the paper price is not a reason to panic, it is a reason to pay close attention to the underlying fundamentals. For smart, dedicated stackers who understand the macroeconomic data, this paper sell-off is the exact mathematical entry point you look for. It is an incredible opportunity to secure high-purity sovereign bullion before the physical deficit completely breaks the fractional reserve paper system. When the industrial giants in the West finally realize that the Eastern vaults have secured all the available inventory, the panic will not be in the paper markets. The panic will be in the physical loading docks. And when that true price elasticity snaps, the paper price will be forced to violently realign with physical reality. You want to be holding the metal in your own two hands before the day arrives. If you found this massive macroeconomic deep dive valuable, it is critical that we get this data out to as many people as possible. Hit that subscribe button right now, smash the like button to help defeat the algorithmic suppression, and ring the bell icon so you never miss an urgent data drop. Let me know in the comments below if you are using this paper dip to add to your physical stack, or if you are waiting for the Federal Reserve to make their next move. Keep stacking, trust the physical data over the paper illusion, and I will see you in the next video right here on the Wealth Reactor.